This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
We're on Pedantic. It's December 2008. Obviously it's question 1 from F7. And in the Kaplan revision kit, it's question 51. Pedantic, 1st of April 08, and we're going to September, so it's partway through the year, this acquisition. Statement of income and statement of financial position, so it's a big one. Okay, working 1, Pedantic and Sophistic. We acquired 60%, therefore there's 40% out there. This is on the 1st of April, and we're going to September, April, May, June, July, August, September. It's 6 months pre, 6 months post. Working 2 is the Goodwill calculation. The cost of the acquisition, share for share exchange, 2 in Pedantic for 3 in Sophistic, and we got 60%. So we got 60% of the $1 shares, so it's 60% to 4,000. For every 3 we gave 2. The share issue has not been recorded, and our shares have a value of $6. So 60% of 4,000 is 2,004. 2,004 divided by 3 is 8. 8 times 2 is 16. 6 times 16 is 9.6. So 9.6 million is ours. The NCI, there's no additional bits there, it's just that. The NCI, point number 5, yeah, it is point number 5. Their value is 5.9 is given. So 15.5 is the value of the company. And we're looking for the fair value of the net assets at the date of acquisition. And we know it's got to be shares of 4,000. Retained earnings brought forward. It's partway through the year, this, so we need retained earnings brought forward and then retained earnings for 6 months. Goodwill is not consolidated. I'm looking at the notes. Goodwill is not consolidated, is not impaired. There's some cash in transit. Point number 3, other than where indicated, income items are deemed to accrue evenly. The sales in the post-acquisition period with a PUP and date of acquisition the fair values. Okay, so profit for the year for Sophistic was 3,000, and the retained earnings. Is there a dividend? Was there a dividend? No indication of a dividend. I'm assuming there was no dividend from the subsidiary. So profit for the year was 3,000, so retained earnings brought forward must be 3,500, and then 6 months profit was half of 3,000, that's 1,500. Then there's going to be a fair value adjustment. There always is fair value adjustment. There always is. At the date of acquisition, the fair value of Sophistic's assets were equal to their carrying amounts, with the exception of a nitro plant. So PPE had a fair value of 2 million in excess. It has a remaining life of 5 years at that date, so we're looking at 400,000 for a full year, and therefore 200,000. So we've got plus 200 depreciation, which I'm going to put onto my question paper. I've got minus 200 plus 2,000 minus 200, and the equity, the retained earnings minus 200. Okay, but that's it for fair value adjustments. That's 11,000. So 4,500 is the goodwill, and it's impaired. No, consolidated goodwill is not impaired. That's goodwill figure. Now we need to go through these. So we've just dealt with point number 1. I've increased the figure on the balance sheet. I've written it into my question paper, plus 2 million, and I've dealt with the depreciation of an additional 200,000 in the post-acquisition period. Sales. So point number 2, we've got the PUP calculation and the intergroup trade. Cancel intragroup trade of 8 million, and I'm doing that now. I'm going back to my income statement. Revenue, I'm putting -8, cost of sales -8. That cancels the intergroup trade. And then we've got cost plus profit equals selling price. We've got a markup on cost of 40, therefore 140 is selling price. I'm looking for the unrealized profit, so it's 40 140ths of the closing inventory. We sold 8 million, we had sold 5.2, so there's 2.8 left. 40 140th is 800,000, and it's in S. So in the S, I'm going to add 200,000. I've got my depreciation in there. Add 200,000. Oh gosh. Add 800,000 cost of sales, and current assets minus 800,000. And therefore minus also in the retained earnings minus 800,000. All right. Point number 3 is dealt with. Point number 4, receivables. Point number 4, receivables. Includes 600 due from Pedantic, which didn't agree with the corresponding payable due to cash in transit from Pedantic. Okay, accelerate the cash. So I'm going to put plus 200, accelerating the cash through to Sophistic, and minus 200 in the current asset. So plus 200 for cash and minus 200 from the receivable. And then receivables include 600. So now that's got to be minus 400. So minus 4, and in the payables too, current liabilities minus 400. So minus 400, minus 400, and the cash is plus 200 minus 200. I'll just do that in T accounts for you. This is Pedantic's book, this is Sophistic's books, this is the Sophistic current account, this is the Pedantic current account. In Sophistic, we've got per question 600, and Pedantic did have 600 but then paid cash, so they only have 400, and that's the position that we're now in. We're unreconciled current accounts. So what I now have to do is take 200 out of receivables and put it into cash, and then cancel 400 against 400. Okay, so 400, my liabilities are going to go down by 400. My current assets are going to go down by 600, but then go back up again by 200 cash. And point number 5, nothing to do. So I think we're ready to do working 3, Pedantic, Sophistic per question. Per the question, we've got retained earnings for 30. This is consolidated retained earnings, 35,400 and 6,005. We've got the PUP of 800, wasn't it? 800, and it was in Sophistic. There's excess depreciation of 200 based on that fair value adjustment of 2,000. And that then is the position today. It's 7,005. If I take away the pre-AC, and the pre-ACs are up here in working 2, that's those, that's 5, 6, 7,000. It means there's 500 post-AC. And our share of that was 60%. Yes, 60%, which is 300. That adds on to my 35.4, which gives me 35,007. If there were, it would now be less goodwill impaired, just our share, but there is none. So 35,007 is the retained earnings for the balance sheet for this statement of financial position. Working 4A is the NCI, and it's 40%. Value at date of acquisition, we were told that, weren't we? We were given that figure, 5.9. And then they want their share of post-ac retained, which is 40% of this 500, which is 200. That gives me 6.1. And if there were any goodwill to impair, it would come off there, but there is none. So that's that. Just one other working 4B, which is the NCI for the income statement. Again, it's 40%. It's of half a year. So it's 40% times 3 half of 3,000, which is 1,500. And then 1,500 had got these two adjustments, didn't they? The 800 and 200. So minus 1,000. So it's 40% of 500. I could have done that quickly, you know. It's here. It's 40% of these post-tax profits. And that's for 200. I've actually already done it here anyway. Of this amount, therefore, at the bottom of the income statement, it's going to say, of this amount, 200 is attributable to the non-controlling interest. Okay, statement of income, revenue, straightforward, 85,000 plus, it's a half of 42, which is 21, minus the 8 cancelled. So 85, 106, 98,000. All right. Cost of sales is 63 plus a half of 32, which is 16, minus the 8,000 cancelled, but then we've got plus the 800 PUP plus the 200 additional depreciation. So that's 79, 71, 72,000, I think. Again, I've no doubt you'll check. I hope you'll check, because I do make mistakes, unfortunately. Distribution costs, 2,000 plus a half of 2,000, which is 1, gives me 3,000. Admin expenses is 6.5 of 3.2, which is 1.6. That's 7,006. Finance costs, there's no unrolling of any discount this time, plus a half of 4, which is 2, that's 500. There's no share of any associates, there's nothing, no complications like that. So 10, 11, 1, 15, 14,900 is PBT. Tax itself is 4.7 plus a half of 1.4, which is 7. 5,400, 9,005 of this amount, that's PAT, of this amount, what do we say, 200, is attributable to the non-controlling interest, and 9,300 is attributable to the members of the parent company. Okay, that's the balance sheet done. Sorry, that's the income statement done. Statement of financial position. Goodwill was in working 2, and I didn't write it into my question paper. I should have done that. Would have saved me going up here. 4.5. PPE PPE is 40,600 plus 12,600 plus 2,000 minus 200. That's 52, 53, 2, 53, 54, 55,000, I think. Again, please check my ads. Current assets 16,000 plus 6,600 minus the 800, which is the PUP, minus 200, which is cash in transit, plus 200, which is cash in transit. So I'm putting it onto cash, taking it out of receivables. And then, was it 400 the rest? Yeah, minus 400 the rest of the receivable. Yeah, I think that's it. So 22,600, 21,600, 21,800, 21,400. Is it 21,004? 80,900. I think shares, we'll have to see. Shares is 10,000. The issue of shares has not been recorded. Just watch out for that. He does this often. Then when we're doing a share-for-share exchange, he'll tell you that the issue of shares and the purchase, the acquisition, has not been accounted for. So we started off with 10,000, but we've issued some shares up here in working 2. For every 3 we issued 2, and we bought 60%, so 2, 4, 8, 1,600. That's 1,600 shares issued. They have a face value of 1, and they're issued at 6. So it's 1,600 times 1 share capital, and 1,600 times 5 share premium. So plus 1,600 is 11,600. Premium is 1,600 times 5, which is 8,000. Retained earnings, that's in working 3, and incidentally always is in working 3. Working 3 tells me retained earnings was 35.7, NCI is 6.1. 35.7, NCI is 6.1, and that's in working 4A. 1119, 5460, 61,400. Any long-term debt? Yeah, we have 10% loan. That's 3 and 4. 7,000. 68,4. Current liabilities was 8,002 plus 4,007 minus the cancelled 400. That's 4,312.5. That's 80,900. Yes, great, super. Now that's, I don't know, you tell me. December 2008, 14:22 is the time. That's 17 minutes. Know where you're going. Practice. These are routine things. There's nothing, absolutely nothing in Pedantic which was at all unusual. Nothing at all in Pedantic which is at all unusual. And you should, if you've been going through all of these recorded answers that I've done for you, if you go through them all, you should by now be realizing that so much is routine. The share-for-share exchange is becoming standard. Time allocation, the acquisition partway through the year, is pretty standard. The top 2 lines in the exam questions, that the date of acquisition, the fair values of Sophistic's assets were equal to their carrying amounts, with the exception of, and that fair value adjustment, with the depreciation knock-on adjustment. The paragraph that says there have been sales, intergroup sales, and we need to cancel them out of revenue and cost of sales, and then calculate the PUP. This, ladies and gentlemen, this is routine, and it should, if you've gone through all these questions, all these answers, and followed these answers with me, then it should be becoming routine. Anyway, that's enough of that. Stop it.